Good morning and welcome to our 10 minutes a little bit before 10 today. We have a meeting at 10, so we thought we'd jump on a little bit early. So today we're going to talk to you about optimising pay between directors' payroll and dividends.
Now, in particular, the end goal of this is to maximise the amount that you as directors can take out of the company. So the most tax efficient pay is to use part dividends and part payroll. Now, often we do see people who forget about payroll sometimes, but it's got so many benefits, it's unreal. So first one is it utilises your tax-free allowance. Second one entitles you to national insurance benefits such as state pension, contribution-based job seekers allowance, that's a mouthful, employment support allowance, and maternity allowance. Third point, it's tax deductible in your P&L, which is fantastic because it relieves some of your corporation tax liabilities. And the fourth one is it can offset against an overdrawn DLA, which can be quite a headache if you've got an overdrawn DLA and you're struggling to reduce it down.
Yes. Now, one thing that we should probably point out here is it's really important to make sure that if you are going to run a director's payroll in your limited company, you don't just take the money, you have to register as an employer and go through the proper PAYE process. So Xero has a really simple payroll function that we use for most of our directors' payrolls. But it's really important to remember first to actually register as an employer and submit your monthly RTIs to HMRC to show them what you're doing. We have seen this in the past where directors have taken the cash, they've posted that cash drawing to the P&L as a wage, but they haven't actually registered as an employer. So the small business, even if it's only got one person on payroll, needs to register as an employer and process payroll properly. Otherwise, it's just a director's loan, isn't it?
Yeah.
Just cash taken out of the business.
And it's vital because then HMRC aren't going to know whether or not you're entitled to your national insurance benefits.
Yeah,
anyway.
absolutely.
So you have to run it through payroll for this benefit. So, what exactly would be the optimal pay?
So this is for a super simple company with one or two directors. Now, it does depend on whether you've got one director or two directors as to how much you might want to pay them, and Harry will talk to you about that in just a moment. But we're assuming this is a very simple company, no other external incomes, no rental incomes, anything like that. So it is, in this example, the most optimum way of getting your cash out of your business for a small company.
Yeah, and we're assuming just dividends,
just payroll. Yeah.
Keep it nice and simple.
Yeah.
So, in an instance where you have two or more people on payroll, the optimal pay is in tax year ending 2020. 12,500. I got tongue tied again. It's 12,500 because that is your tax-free allowance. So if you pay up to 12,500, you won't have any PAYE to pay. Now, because you have two or more people on payroll, this means you're entitled to employer's allowance, which means that any national insurance employers charge you get a £3,000 relief for the year, which basically, if you're paying at the tax-free allowance, means you have no employer's national insurance to pay, which is wonderful outcome. Now, if you only have one person on payroll, you don't get the employer's allowance.
No, they did. They allowed it the first year, which was quite nice, and then they took it out the second year, didn't they? And
because they realised that everyone was just all the single director companies were obviously getting the benefit, and HMRC didn't take too kindly to that. No. So just basically changed it, and you had to have two or more people on payroll.
Yeah. So if you have you and a spouse, that works quite well.
Yeah.
So husband or wife or partner, whatever. That works really, really well. So if you can employ them in the business to help run your business, then that's great. And that allows you to take advantage of that employer's allowance.
But if you can't, and there's just the one of you, the most efficient tax-free payroll is 8632, which is the same as the primary threshold as at the year ending April 2020.
So why is it important to pay yourself to the primary threshold for national insurance?
So if you pay underneath this, you don't actually get the national insurance benefits. So 8632 is the optimal amount because you receive all of these entitlements.
But you don't actually pay any national insurance, do you? It's right on the cusp. So you get all the benefits of the national insurance system, but none of the charges, which is quite nice.
Yeah.
So I don't
that's the
suppose it'd be
cheeky
very
way.
long before HMRC wipes that one out as well.
Yeah, who knows? But for now, actually, that's been going for a long time, so you might be lucky at getting away with that one. But yeah, 8632, keep it to the primary threshold
Yeah.
and take advantage of getting those national insurance benefits.
Yes. Now, the other thing that is really important is to pay yourself a dividend. So, assuming you are making profits, and of course, we all hope you are, if you're making profits, you can then pay yourself a dividend, and you have to pay that out of after tax dividends. So, make sure that your profit and loss account is up to date. Make sure that you have provided for your corporation tax charge, and then you can see how much profit is left available for you to distribute. And that's something that your accountant can help you with. If you have lots of capacity in your business, and a lot of our clients do, which is great, it means that you can take that extra dividend out without worrying too much about whether your business has the capacity to pay it. And we don't want anybody declaring illegal dividends and taking them out of non-retained earnings. So it can get a little bit complicated. If you've got lots of profit in your business, that's great, and you can take that dividend. Now, the advantage of taking the dividend is that the first £2,000 of your dividends in the tax year are tax-free. Yay! And then after that, it's 7.5% tax at the lower tax rate. So it is a much more efficient way of paying yourself out of your business by paying the dividend, which is a much lower rate tax than the income tax you would be charged on payroll. So that's why you see people taking tiny little directors' payrolls and big pots of dividend. Now, if you have a spouse involved in your business and they have 50% of your shares, then that allows you to then distribute your shareholding, distribute your dividends, and you can both take advantage of that lower level of tax. So that's one of the things that we often look at when we take on a new client, is to make sure that that tax split and that dividend split is optimal. There are other reasons why it's good to have shareholders and partners as directors in your business. Some of that would be for business protection. So if something happened to you and you weren't able to manage the business or run the business in your absence or sickness or whatever had happened, your partner would be able to run the business for you, and it just makes things a whole lot easier. So a little extra tip there on having directors, co-directors in the business, helps both payroll, helps your shares, and it helps with the dividend and control.
Yep.
So that is us for today. So, oh no, it's not. I didn't mention the high earners.
Yeah, the warning.
High income
the little
benefit
warning.
charge. Yeah, there you go. So keen to get to the door. Right. So, one big beware. If your income exceeds £50,000 per year and you have children, you probably claim the child benefit. You get child benefit payments. Now, if either one of you in your household earns over £50,000 a year, there is a high income child benefit charge which claws back some or all of that tax charge or that benefit. So if you earn between 50 and 60,000, there's a tapered charge to recover some of that child benefit that you have received. If you earn over 60,000, all of that child benefit will be clawed back. So at that point, it's often more beneficial to not claim the child benefit in the first place than it is to claim it and then have to pay it back later on and have that added to your tax bill, because obviously you get it in 4 weekly payments during the year, and then you have to pay it back in one lump sum at the end of the year.
And just to add a little detail to what we mean by tapered, if you earn £50,001, you don't lose all the benefit. You lose a teeny bit. But if you earn closer to 60,000, you lose progressively more.
Yeah.
So that's how that works, and that's what the tapered earnings means.
It does.
You do hear that term a lot in accountancy, but I don't think anyone really actually ever explains it. So...
like I didn't.
Quite proven.
Yeah, so it's fantastic. Right, okay, so that's brilliant. So that's it for us today. Somebody has just so if you either earns 100k or more, you can't apply for tax free childcare. Yeah, that's correct. So that is a bit unfortunate. So there's a lot to be said for. No, I don't know. Is there a lot to be said for not earning that amount? If you earned that amount, would you really care if you could not apply for tax-free childcare or things like that? Presumably, at that point, you've got so much cash you can afford to pay for everything yourself. I don't know. I don't think I'd care at that point.
That's what
I'd
you'd
be
hope.
too
Yeah.
chuffed not to have to pay for it. That'd be quite an accolade, wouldn't it? So that's us today for our 10 minutes at 10. We will be going live later on today to do our day 2 because we were super busy yesterday and didn't get to record one. So we'll be back a little bit later with day 2 of our optimising payroll for this week. We'll speak to you soon. Thanks for now. Bye.
Bye.